Hello and welcome to Lecture 8. We are going to be discussing mortgage markets. This comes from Chapter 9 in the book. Hopefully you've read the chapter prior to viewing this lecture, but let's go ahead and jump in. So the objective of the chapter is to provide a background on mortgages. So we'll discuss mortgages and how they work, describe the common types of residential mortgages, explain the valuation and risk of mortgages, and explain mortgage-backed securities. So, a little background on mortgages. Most of us are very familiar with what mortgages are, whether we've had one or not. Usually a family member has had one, and we hear about it in everyday life. A mortgage is a form of debt to finance a real estate investment. So I own my house. Well, I borrowed money from the bank in order to purchase my house, and I currently have an outstanding mortgage as a result. So I owe its debt. I owe the mortgage. I owe the amount to the bank, but I was able to finance real estate as a result. So the mortgage contract specifies first the mortgage rate. So I'm currently in the middle of a refinance, and my new rate is 2.875. Which is great, but that's the percentage rate. Maturity, typical maturities for residential real estate, 30 years, 20 years, 15 years. My newly refinanced mortgage is going to be a 15-year. And then collateral, this is what backs the loan. And it's almost always the real estate that the person is borrowing the money to purchase. So the originator charges an origination fee when providing the mortgage. So you borrow the money and you not only get to pay them interest, but you get to pay them an origination fee at the onset of the mortgage. Most mortgages have maturities, as I mentioned, of 30 years, 15 year maturities are also available, and I mentioned 20 years as well. So how do mortgage markets facilitate the flow of funds? And if you look in your book, Exhibit 9.1, that will give you an idea of how that happens. We're going to discuss it here and take a look at the exhibit in just a second. Mortgage originators obtain their funding from household deposits and by selling some of the mortgages they originate directly to institutional investors in the secondary market. So an originator has to have money to lend, and they can either lend it by receiving deposits from households. So in the case of a bank, people will deposit money in the bank. The bank can then lend that money out in the form of mortgages. Or they can take existing mortgages, sell them, and then take the money from the mortgages they sold and reinvest it. So these funds are then used to finance more purchases of homes, condominiums, and commercial property. Mortgage markets allow households and corporations to increase their purchases of homes, condominiums, and commercial property and finance economic growth. So here's a diagram of how this is done. So we've got households. They will deposit funds into these financial intermediaries. These financial intermediaries, I mean, these would be things like a bank. So deposits go into the bank. The bank might already own mortgages, so they might sell those mortgages to institutional investors, or potentially another mortgage company. So we were with Quicken Loans first, then my mortgage was sold to a company I'd never heard before called NewRez. And so the mortgages, they have the originators have a right to sell that mortgage to a different institution, which they will pay money to buy the mortgages off of the original originator. Also, mortgages can be sold to federal agencies, so not only institutional investors, but federal agencies. Institutional investors will also send money toward federal agencies by buying the bonds, which are backed by mortgages. And we'll talk about mortgage-backed securities near the end of this lecture. So the financial intermediaries, these banks that have got deposits or sold other mortgages or assets that they now have funds to loan out. And so they can make mortgage loans for purchases of homes and condominiums or purchases of commercial property. And so that is how a mortgage market facilitates the flow of funds. So institutional use of mortgage markets is very common. Mortgage companies, savings institutions, and commercial banks will originate these types of mortgages. Mortgage companies tend to sell their mortgages in the secondary market, although they may continue to process payments for the mortgages that they originated. So in this case, it would be like my Quicken Loans sold my mortgage on the secondary market to another company called NewRez, and Quicken Loans could, if they had chosen to, continue to process my payments for NewRez. The common purchasers of mortgages in the secondary market are savings institutions, commercial banks, insurance companies, pension funds, and some types of mutual funds. So here we've got a chart showing institutional use of mortgage markets. When I was CFO, we had the opportunity to purchase some property that we had been leasing. And in order to get that property, we negotiated a mortgage through a bank. And so you can look at the institutional use of mortgages is when an institution is using the mortgage. So we've got commercial banks and savings institutions, and they'll originate and service commercial and residential mortgages, bundle packages of mortgages, and sell mortgage-backed securities or purchase mortgage-based securities. Credit unions and finance companies, mortgage companies, mutual funds, securities firms, and insurance companies. I recommend you take a look and become familiar with these different institutions and how they might use the mortgage markets. A little background on mortgages. Not everybody is able to pay back a mortgage. As we see that, people sometimes have to, or default, are not able to pay. And so one of the things that banks do, or the lenders do, the originators, is to measure the creditworthiness of the borrower, whether that be an individual or a company. They're going to use certain criteria to measure the creditworthiness. So the level of equity invested by the borrower is one measure. In other words, how much are we borrowing? So if you've got a house that's going to cost $500,000, if the person who wants to buy the house is going to put down $400,000 and only borrow $100,000, there's not a lot of risk involved to the originator, the bank who's lending the money, because they know that the borrower will lose a lot more if they default on their loan, because the bank would then get the property. And so there's an incentive there. The more down payment is used, the less risk to the originator. And so the lower the level of equity invested, the higher the probability that the borrower will default. So if they only are able to put maybe 5% down, they don't lose a lot if they walk away from a mortgage or default on it. So one proxy for this factor is the loan to value ratio. So you'll hear this often. What's the loan to value? Which indicates the proportion of the property's value that is financed with debt. So the loan to value of my example with a $500,000 home, where the purchaser was able to put in $400,000, the loan was only $100,000. So it would be $100,000 to $500,000, the value. So it's a 20% ratio. A lot of banks will have certain rules that they don't go over a certain amount in a primary loan. So it might be 80% of loan to value. They would not lend above that. Another criteria is the borrower's income level. So borrowers who have a lower level of income relative to the periodic loan payments are more likely to default on their mortgages. So they'll look at, well, what's your monthly income, monthly disposable income, and what percentage of that income would be your loan payment. And the higher the percentage, the more risky or the less creditworthy the investor or borrower is. The borrower's credit history is another one. Borrowers with a history of credit problems are more likely to default on their loans. And those who have defaulted on a residential loan in the past, it will be more difficult for them to borrow again because the banks don't want to be burned twice. Okay, so there are also different classifications of mortgages. We've got prime versus subprime mortgages, and you probably have heard these words before. We're going to define them right here. Prime the borrower meets traditional lending standards. Okay, so this is a prime borrower, and banks love prime borrowers. They're more likely to pay back the loan. The banks will have the least amount of cost related to potential default. So those are prime borrowers. The subprime, the borrower does not qualify for a prime loan. So banks won't traditionally lend to them. They typically have relatively lower income, high existing debt, and can make only a small down payment. So those are subprime. And in the credit crisis that we saw in 2007, 2008, a large number of the borrowers and the mortgages that were a part of the problem with the credit crisis were subprime mortgages. Then there are insured versus conventional mortgages. So they could be insured. A loan is insured by the Federal Housing Administration, FHA, or the Veterans Administration, the VA. Conventional, the loan is not insured by FHA or VA, but can be privately insured. So insurance helps to ensure that the mortgage will be repaid. We've got different types of residential mortgages, which we will define here in just a second. We've got fixed rate mortgages, adjustable rate mortgages or ARMs, graduated payment mortgages, GPMs, growing equity mortgages, second mortgages, shared appreciation mortgages, balloon payment mortgages. Okay, so a little on fixed rate mortgages. It's pretty clear what they are. It locks in the borrower's interest rate over the life of the mortgage. So I mentioned earlier that I just refinanced to a 2.875 rate. That is the fixed rate. It won't go up, it won't go down, it's fixed. And over the life of the 15-year life of the mortgage, it'll remain at 2.875. Financial institution that holds fixed rate mortgages is exposed to interest rate risk because it commonly uses funds obtained from short-term customer deposits to make long-term mortgages. So what would happen to a lender who lent to me at 2.875 fixed rate, but then we see rates rise. And so now they're gonna have to pay higher interest to the short-term deposit customers. And that can be an issue. So what typically happens is a customer will deposit funds in the bank. The bank agrees to pay them a small interest amount. So in the current environment, it's certainly less than 1%, a typical savings account. But those funds are sitting in the bank, and then the bank is able to use those funds to lend them out. And the bank will lend it out at a higher rate than what they're paying the customer who deposited. But the customer will demand a higher rate if rates increase. So even though this fixed rate mortgage is there, they're going to end up having to pay more if rates rise, which means that the bank will lose money. They're only receiving 2.875 from me, but what if customers demand 3% on deposits in the bank? And so you can see how the risk there can be significant, especially when we are at all-time lows. Borrowers with fixed rate mortgages do not suffer from rising rates, but they do not benefit from declining rates. So my rates are about as low as I would ever expect to see them. As a result, I won't suffer from an issue with rising rates. However, those who are not in fixed rate mortgages will have that happen. And we've got what we call an amortization of the loan. So amortizing fixed rate mortgages. An amortization schedule shows the monthly payments broken down into principal and interest. And we're going to take a look at that very soon in Exhibit 9.3 after this page. So that was fixed rate mortgages. Actually, you know what? Let's go back. Let's do a new share, and we're going to share. Okay, so this is an amortization schedule. So what we see here is we've got a house that was purchased, and we've got the date of the payment. So there's a payment on the first of every month, as you can see. The payment is the same. So this is what happens when there's an amortization schedule. The payment remains the same, but the amount going to interest and principal changes every month. That's because the interest is calculated off of the outstanding balance. So the balance at the end of this month was $277,000. So the interest is calculated after off of this new balance. So the payment remains the same. The interest is calculated off of that balance, and whatever's left over will go to pay down the balance. It's called going against principal. And so you can see the balance will drop by this $346. It drops from $611 to $265, which in turn reduces the interest rate. So over time, what you see is the interest amount paid every month decreases. And you can see that it drops below 1,000 there, and the amount going to principal increases. And this happens over the life of the loan. And so for a 30-year loan, what you'd end up seeing would be the last payment would have almost no interest and almost all principal payment. So this is what we call an amortization schedule. And this is what is created in order to know how quickly and how much is being paid off of the mortgage. So that was the amortizing fixed rate mortgage. Now let's discuss ARMs. These are adjustable rate mortgages. It allows the mortgage interest rate to adjust to market conditions. And so if rates go up, the ARM will adjust. It'll go up as well. If rates go down, it'll go down as well. So if you were in a high interest rate environment, you might want an ARM rather than another type of loan, a fixed rate, because you would expect that that rates would go down and that you would benefit from that. The contract will specify a precise formula for the adjustment, however. Some ARMs contain a clause that allow the borrower to switch to a fixed rate within a specified period. And I've also seen loans where it was fixed for a period and then it converts to an ARM. ARMs from the financial institution's perspective. Because the interest rate of an ARM moves with prevailing interest rates, financial institutions can stabilize their profit margin. So they can earn just the same amount, no matter if it's going up or down, because they'll have a markup, if you will, on what they have to pay versus what's being paid to them. If market interest rates move outside given boundaries, the profit margin on ARMs could be affected. And so some ARMs will have stated boundaries of how high or how low the interest might be allowed to go. We're going to skip this page. This is another example of an amortization schedule that you can see in your book, Exhibit 9.3. Okay, so here we've got a comparison of rates on newly originated fixed rate and adjustable rate mortgages over time. The red line shows our adjustable rate mortgages, and the blue line shows fixed rate mortgages. And you can see in almost every instance of time from 2004 to 2013, and it is true still today, typically ARMs have a lower rate. And so that's how banks kind of get people interested in them. But what happens when the rates rise? They'll go up, and they can go up higher than a fixed rate mortgage, depending on the environment. For those who are in ARMs, they have been lucky to have been in an environment that we're in where the rates are artificially low because of what's been happening in our economy. And so, but traditionally, there's a lot more risk with an ARM versus a fixed rate, because that rate can rise well above the fixed rate. Okay, now on to our next type of residential mortgage. It's called a graduated payment mortgage, or a GPM. This allows the borrower to make small payments initially on the mortgage. The payments increase on a graduated basis over the first 5 to 10 years and then level off. So it'll start off small and then go up and then level off. So why would somebody be interested in a graduated payment mortgage? Well, what about a new professional who's just graduated from university, not making very much in their first job, but their income is expected to rise over the next 5 to 10 years? Maybe in order to get into the house that they want, they may use a graduated payment mortgage so the payments are lower at first and then go up later on. Then there are also growing equity mortgages. These are similar. The monthly payments are initially low and increase over time, like graduated payment mortgages. However, the payments never level off. They continue to increase throughout the life of the loan. So maybe they'll go up 4% a year, and it'll just keep going up. So these are what we call growing equity mortgages, and that'll grow until it's paid off. There are second mortgages. A second mortgage can be used in conjunction with a primary or first mortgage. So I mentioned some banks will require that you cannot borrow more than 80% of the value of the property. What if you only have 10%, enough to make a 10% down payment? What do you do with the other 10%? Remember, the bank's only going to loan 80, you've got 10. So what you can do is you can go out and get a second mortgage and borrow the other 10%, which will allow you to get into the home that you're looking for. There are things called shared appreciation mortgages. This, and I've never met anybody who's done one of these. This allows a home purchaser to obtain a mortgage at a below market interest rate. In return, the lender will share in the price appreciation of the home. So the lender, it's an investment in real estate. So the lender shares in the price appreciation, but takes a lower interest rate. Also, there are balloon payment mortgages. This requires only interest payments for 3 to 5 year period. At the end of this period, the borrower must pay the full amount of the principal. So in my example of a $500,000 mortgage, if it was a balloon payment, typically the borrower is only paying the interest. And then at the end of the 3 or 5 year period, the borrower has to pay the full amount. So the full $500,000, because no amount of principal has been paid down before the balloon payment is required. Okay, so this is a little bit of math. If you were in my Finance 3250 class, we know how to value a mortgage. That was one of the practice problems we do. So the market price, PM, of a mortgage should equal the present value of its future cash flows. In other words, we look at the remaining payments that are there and we calculate the present value. So let's say it was a 30-year mortgage and we've been paying for 10 years, so there are 20 years left. So we would calculate the market or the present value of the remaining 20 years of payments. This is mathematically how it's done. PM is the market price of our mortgage. C is the interest payment. So remember, our mortgage payment is made up of both interest and principal payment. So C plus PRIN, this is our interest plus the principal payment. And to discount it, we're going to divide it by 1 plus K to the T. T stands for time. And K is the required rate of return. And so we can calculate what is the current market price for the mortgage. What is it worth in the market today? Okay. There are risks in investing in mortgages. There's credit risk. This is the risk that the borrower will make a late payment or default. So that is real, especially if the criteria used to determine creditworthiness is weak. If that criteria is weak, then the bank or lender might leave themselves open to credit risk. There's interest rate risk. This is the risk that that value of mortgage will fall when interest rates rise. So when the interest rates rise, existing debt, the value of it goes down. Also, there's a risk of prepayment, the risk that the borrower will prepay the mortgage when interest rates fall. And this happens. I mean, I'm right in the middle of it right now. I'm prepaying my former mortgage because the rates have dropped and I'm refinancing. So what am I doing? I'm borrowing money from this new institution to pay off my old institution, and I'll pay my new institution a lower rate than the old institution. And so banks have a risk that people will refinance or prepay the mortgage, which means that the lender doesn't get all of the interest they were anticipating. Okay, now we're going to talk about mortgage-backed securities, MBS. And in order to understand mortgage-backed securities, we need to understand the concept of securitization. Securitization is the pooling and repackaging of loans into securities. Securities are then sold to investors who become the owners of the loans represented by those securities. Okay, so what happens are institutions will buy up a bunch of mortgages, they'll put them together, they'll package them into a group, a pool, and then they will sell securities. It's almost as if they've set up a new company, and the assets of the company are all of these mortgages. They've put all these mortgages into this new company, and investors can buy into the new company. What do investors get? Well, they get the interest and principal payments from those loans. And so they are paid, they get a rate of return. And so this is called securitization. So these securities are backed by mortgages. So that's why they're called mortgage-backed securities. A little on the securitization process. A financial institution such as a securities firm or commercial bank combine individual mortgages together into packages. The issuer of the mortgage-backed security assigns a trustee to hold the mortgages as collateral for the investors who purchase the securities. After the securities are sold, the financial institution that issued the mortgage-backed securities receives interest and principal payments on the mortgage and then transfers, it's called a pass-through entity, transfers the payments to investors that purchased the securities. Okay. There are different types of mortgage-backed securities. Ginnie Mae mortgage-backed securities, private label pass-through securities, Fannie Mae mortgage-backed securities, Freddie Mac participation certificates, and collateralized mortgage obligations, CMOs. So these are different types of mortgage-backed securities. Looking a little deeper, Ginnie Mae mortgage-backed securities, the Government National Mortgage Association, GNMA, Ginnie Mae is its nickname, was created in 1968 as a corporation that is wholly owned by the federal government. So it's similar to an agency for the federal government. It guarantees timely payment of principal and interest to investors who purchase securities backed by FHA and VA mortgages. So they deal in packaging up FHA and VA mortgages, which are insured, so it reduces the risk. Private label pass-through securities, these are backed by conventional rather than FHA or VA loans. So they're not insured through FHA or VA, but they are insured typically through private insurance companies. Fannie Mae mortgage-backed securities, the Federal National Mortgage Association was created in 1938 to develop a more liquid secondary market for mortgages. Channels funds from institutional investors to financial institutions that desire to sell their mortgages. Then we've got Freddie Mac participation certificates. The Federal Home Loan Mortgage Association was chartered as a corporation in 1970 to ensure that sufficient funds flow into the mortgage market. It sells participation certificates and uses the proceeds to finance the origination of conventional mortgages from financial institutions. Fannie Mae and Freddie Mac enhanced liquidity in the mortgage market. And we're going to take a look at how that is brought to pass. So we'll start on the left-hand side and we'll work our way right. Financial institutions that purchase securities issued by Fannie Mae and Freddie Mac. So they have funds. Those funds flow to Fannie Mae when they purchase the securities which are backed by mortgages. Fannie Mae will then move those funds to financial institutions that originate mortgages. So they will deposit them into these or allow them to be used for loan origination. And then these financial institutions will be the ones to create the mortgage loan, lend it out for the purchase of homes and condominiums. Likewise, these financial institutions that originate mortgages, they might sell their mortgages to Freddie Mac, which will package them up and sell them as securities to financial institutions. So there's a lot of different players doing different things, going different directions. So the last is we've got CMOs, collateralized mortgage obligations. Mortgages are segmented into tranches. I think we talked about this in the last lecture. According to their maturity and the cash flows provided by each tranche are typically structured in a sequential manner. Any repaid principal is initially sent to owners of the first tranche until the total principal amount is fully repaid. Then principal is paid to the second tranche. This process continues until principal payments are made to owners of the last tranche, CMOs. Issues of CMOs typically have from 3 to 10 tranches. So CMOs, there's going to be different levels of maturity in the CMO. Sometimes they are segmented into interest only and principal only tranches. Some mortgages are also sold through a collateralized debt obligation, a CDO, which is a package of debt securities backed by collateral that is sold to investors. So what about the valuation of mortgage-backed securities? The valuation of mortgage-backed securities, it's difficult because of limited transparency. So they buy them, they package them up, they put them together, and then they sell a security that is backed by them. And there's no centralized reporting system that reports the trading of MBS, mortgage-backed securities, in the secondary market. So what we have to do is we have to rely on ratings to assess the value. Investors can rely on rating agencies such as Moody's, Standard & Poor's, or Fitch. Also, many institutional investors will not purchase mortgage-backed securities unless they are highly rated. This is a way to help to try and eliminate some of the uncertainty and risk associated with investing in mortgage-backed securities. I've got a friend who worked in mortgage-backed securities during the credit crisis and made some, by his own admission, some lucky bets, and really made a lot of money as a result of what was happening in the mortgage-backed security market. We also have here the fair value of mortgage-backed securities. So there was ratings to assess value, then there's the fair value. It may attempt to rely on prices of mortgage-backed securities that are traded in the secondary market in order to determine the market value. So you can look and see, well, how are they traded? What was the trading price? And we can see what they're valued at based on what somebody was willing to pay for it. Okay, so this brings us to the summary of our mortgage markets lecture. I'm just going to read through the summary just to make sure that we are all on the same page. So residential mortgages can be characterized by whether they are prime or subprime, whether they are federally insured, the type of interest rate used, fixed or floating, and the maturity. Quoted interest rates on mortgages vary at a given point in time depending on these characteristics. There are various types of residential mortgages that are available, including fixed rate, adjustable rate mortgages, graduated payment, growing equity, second, and shared appreciation mortgages. The valuation of a mortgage is the present value of its expected future cash flows, discounted at a discount rate that reflects the uncertainty surrounding the cash flows. So that's the required rate of return based on the uncertainty. A mortgage is subject to credit risk, interest rate risk, and payment risk. A little on mortgage-backed securities. They represent packages of mortgages. Payments on those mortgages are passed through to the investors. Ginnie Mae provides a guarantee of payments on mortgages that meet specific criteria, and these mortgages can be easily packaged and sold as well. Fannie Mae and Freddie Mac issue debt securities and purchase mortgages on the secondary market. Finally, mortgages were provided without adequate qualification standards from 2003 to 2006. So including allowing very low down payments. People could borrow 100% of the value of the home. We saw a glut in the housing market caused by a drastic decline in home prices, with the result that the market values of many homes were lower than the mortgages. So we call that upside down. Many homeowners defaulted on their mortgages, so they quit paying their mortgages, which led to the credit crisis in the 2008-2009 period. The US government used various strategies to revive the US mortgage market, including an Emergency House Recovery Act, the rescue of Fannie Mae and Freddie Mac, which would have gone bankrupt without the help of the US government, and a bailout of financial institutions that had heavy investments in mortgages and mortgage-backed securities. The government's done a lot to make sure that we have a strong mortgage market. If you want to know a little bit more about the credit crisis and how it was affected by homeowner defaults and other things, please refer to your book. If you have any questions, please contact me during my office hours. With that, we will close the lecture. Thank you very much.